Hi, I'm Dave Monty and welcome to my video series, Everything Villages. Today we're going to do a market update on the villages. It is August 2022, so stay tuned. As always, a little bit of housekeeping before we get started. If you like this video, please hit like, please subscribe to my channel. Both of those actions help these videos get to more people, and I greatly appreciate it. As always, I have a free 42-page guide, buying and selling a home in the villages. If you'd like your free copy, just email me right here at davemontysales@gmail.com, and I'll send you out your copy. That guide covers most of the topics that I cover in my videos. It's just put together in a more fluid format. I usually do these updates every 2 to 3 months because things don't change that rapidly, but we are seeing some changes. Now, I keep getting asked to do these updates, and the predictions that we've been making over the last couple months are holding true. So these videos are not changing too much between update to update, but I am going to have a little bit more of some specific information as to what's going on overall in the U.S. economy and what's going on here in the villages. As you know, the interest rates are continuing to increase, although last week there was a little dip in the mortgage rates. At the same time, the Fed was hiking the primary rates on the back end. So not sure how that works, but in general, we are starting to see interest rates in around the 5%. And I checked this a couple of days ago as I was putting together this presentation. Almost the same thing that I said in the video that I did in July is that there's been a huge just jump in inventory, but it's remained steady at that jumped rate. So we were averaging anywhere between 45 to 60 homes on the market at any time during the COVID pandemic. And then just at the beginning of this month, the amount of inventory jumped into the 200s, and we're seeing homes hover between maybe 210 to 230, the number of homes that are on the market. But that's remaining steady. Prices continue to increase. But my opinion is that there's more of a momentum increase than there is a true value in the homes, and I'll explain that in one of the graphs that I have. For all those who have seen these videos in the past, you understand what this is, months of inventory. For those of you who have not seen this metric before, the months of inventory is basically a metric that tells you the health of the market. A balanced market is 6 months worth of inventory. How you arrive at this number is you take the current levels of the inventory and divide it by how fast the homes are growing. So if there are 200 homes on the market and you're selling about 100 homes a month, then you've got 2 months worth of inventory. And that's exactly what's going on right now. I actually don't think I changed some of these numbers, but right now there is about 2 months worth of inventory. All right. So here's a graph of that. And as you can see that we're not too far off the trend that we've had over the last 5 years. It's just that COVID really depleted the inventory here, and you're now starting to see it kind of creep back up to normal levels in here. So we might see a rise and then it come back down. But in general, 2 months is still a very strong, healthy seller's market, but it is softening up for the buyer's side a little bit, which is good news for the buyers at least. Right? The average days to sell. So this takes all the homes that have been sold over the last few months and averages out how long they sat on the market before they sold. And as you can see, that was steadily declining here in the villages. And, we're actually almost at where we would have been naturally if this anomaly hadn't occurred with COVID. But you're starting to see this number creep up a little bit. However, if I look at the homes that are currently on the market, they're averaging 40 days. So I do anticipate this number to grow. It always is not as, it always kind of lags behind, that 1 point of what's going on today. But in general, I do anticipate that the number of days that homes are taking to sell is going to increase as we go forward here. All right, so what's happening to pricing? That is the big question. So we'll show you what has happened, and then we'll try to predict what's going to happen here, at least over the next few months. It's hard to predict any further out than that. As you can see, the pricing in the villages has constantly increased. There's a lot of little anomalies that happen in here. You might have really nice homes come on the market because I'm doing price per square foot here. You might have more homes with pools, etc. So if I go compare month to month, there is going to be some up and down. So what you're trying to do is look for trends here. And like we sort of predicted is that the pricing was going to shoot through this upper level of this channel of pricing. And then even like in stocks, when you see this happen, there tends to be a correction and it will tend to try to correct itself back into the channel. And that's exactly what's happening now. Question is, will it continue down to here or will it start to hover around this upper limit? Okay, on this graph, I want to kind of show you what I believe is going on as far as pricing here in the villages and what I mean by price momentum. And what I'm going to show you here is ask price. And I just put these lines on the graph myself. They don't really indicate the exact numbers over here on the left-hand side or even correlate with the times down here. If I were to guess, we're about right here. These are only here for illustration purposes. So here's ask price, here's sales price. And as an example, I moved this down slightly just for illustration purposes so you can see it. But in general, in the villages, on average, obviously homes sell over list price and some homes sell well below list price, but on average, it's between 99 to 100% of the time the homes sell for about what you're asking for. But I moved it down here just so you could see it. So here's what's going on with pricing is pricing has slowed down. And this is sales pricing has slowed down. We've even seen it dip a little bit. But all the prediction is that we're going to still see continued growth, but slower growth than even a little bit before the pandemic, as definitely during the pandemic. Right? So, but what's happened is that asking prices are sort of on the old trajectory of what they were selling at. And I believe this is why you're seeing an increase in inventory. There's just a huge delta between what people are willing to spend on a home and what is being asked right now. Now, this will correct itself. We are seeing price decreases every day, but they're decreasing it down to here. It's still a little bit more than it was, months ago, okay, but they're lowering their asking price. And then when you lower your asking price, the sales price will come down. And when sales price comes down, those will start feeding into the market analysis we'll do. So you should start to see even asking prices start to level off as well. What is going to happen to pricing? Well, the biggest thing that's affecting pricing today are the interest rates hikes that the Fed is doing right now in order to slow the rapid growth that we have going on in the U.S. right now. Okay, so Freddie Mac predicts for every 1% of interest rates increase, and there shouldn't be a space there is a 5% drop in the number of buyers. And for every 1% of increase in mortgage rates, you see home values drop by about 4%. Now, again, we're dropping from historical trending, so we're just going to see it level off here. So the interest rate hike effects, this is what you see. And this graph looks worse than it is because, you're starting at 50%. But confidence in the housing market, it was very strong. And now you're starting to see people not have as much confidence in it. But it's still where we were 2 years ago before everything hit the fan here. So, so you still have kind of a strong market. On average, we've been seeing about 59%. So, and that makes sense. Like, we said on that previous slide that there's been a 10% reduction because we've gone up 2 percentage points in the number of buyers, and that's indicated on this particular graph. Okay. The big question on everyone's mind, and especially buyers, is they want to see a crash. They want to see prices come down. Now, it's kind of not the best thinking in the world because they have to typically sell a house up north. And so, should you wait? That's the question. And this is going to be, it's not a biased answer because it's my honest opinion, but it's going to sound biased. I don't think you should wait. The reason is everyone's predicting that homes are going to continue to increase in pricing. And the villages actually can protect itself from a crash much stronger than the rest of the economy. So if there happens to be more of a crash or complete lowering of pricing, then you're going to get less for your home up north and still pay a little bit more for a home down here in the villages. So if any time to hop into the market, it's actually not to sit on the sidelines. Now, having said that, if things actually crash next year, again, I don't have a crystal ball. It's just an opinion as to what's going on, and I'll back that up a little bit. So I pulled this right from all the, they don't anticipate a crash anytime soon. Demand continues to outpace supply. Demand actually continues to increase even though there's fewer people in the market. All that demand needs to be satisfied before the market can correct itself. So right now, there's still a huge disparity between the amount of demand and the supply. Right? So prices will grow, but it will grow much slower. The Villages has an advantage over the rest of the market. So if I take a look at 2008, which was a crash. Now, why don't we anticipate a crash now versus 2008? Well, 2008, the economy was popped by the housing market. Right now, the housing market is being affected by the overall economy. So it's completely different. In 2008, you had a lot of people default on loans. And when they're defaulting on loans, those homes go into foreclosure, which are sold for pennies on the dollar. So if I'm trying to sell my home and I got a foreclosure next to me, I got to lower the price of my home to be fairly close to that foreclosure. So it was all of the bad loans which caused that crash in pricing. In the U.S., there was probably about 30 to 35% price decrease, depending on where you were in the country, on home prices. In the Villages, it was only 9%. And I'll explain why I think that's the case. These people are still retiring, and this is about where we are on the curve. If we just minus off 60, 65 years, we're right here. So we still have a great number of people retiring, and I think, if I remember, the number of retirees per day is something like 10,000 people per day. And this graph shows the number of people that are turning 65 each day. And it kind of matched the numbers that I said. You get a little under 5.5. So 65, so you get, 10,000 people a day who are reaching the age of 65 here, almost 11,000 people a day turning 65. And that number does decrease over time. But again, this is... here's 10 years out right here, and you still are going to have over 10,000 people a day who are retiring. Population growth, you continue to see the number of people over 65 continue to grow, even, because baby boomers are still alive, and you get more and more people retiring. Okay, so the number of people over 65 is going to continue to grow. Demand is still going to be there for the Villages. Okay. Now, when there's an economic downturn, the average villager is not affected as much as someone who's 35 years old. They don't lose jobs. Retirees don't lose jobs. You have larger and more diversified portfolios. And a lot of these retirees have the ability to pay cash. So even the interest rates are not affecting a good 60 to 65% of the buyers who are coming into the Villages. Where they get affected is trying to sell their home up north sometimes. Okay, and that's what happened in 2008 in the Villages. It wasn't that the demand for the Villages went down. It was more that people couldn't sell their homes up north for anything that they felt was a reasonable price. So the demand for wanting to be here was still here. The ability to get here was limited during 2008. Okay. The Villages is a fantastic place for investors, both in the short-term and long-term markets. You got someone who's not going to, you don't have college students who are going to destroy the home. You've got, it's a strong, very strong vacation destination for seniors. So you still have a very strong rental market on the short term, and then the long term, there's still, again, a strong market. So investors are continuing to be interested in the Villages. And then lastly, the Villages has a little bit of inventory control. They can throttle back on what they produce in order to maintain pricing. It is in their best interest to maintain pricing through a dip. In 2008, they were actually not lowering pricing, but they were offering incentives like free golf carts and free furniture. I don't think they'll do it this time, but in general, they have the ability and a lot of different strings to pull in order to keep pricing level here. The other thing that's very interesting is that I believe what drives the pricing here isn't the new home pricing. What drives it is people wanting to be in the traditional part of the Villages. So the Villages has grown word of mouth. So, years ago you had 50,000 people here and 50,000 mouths talking about the Villages. Now you get 150,000. So you have 3 times the demand, and that's pretty much how they grow, is through word of mouth. So the demand continues to grow, and just a small percentage of those people want to be up in the traditional part of Villages north of Highway 44, and there's not any more homes being built up here. the demand is going to continue to outpace the supply in some of the more desirable areas in the villages. So I do think you're going to, again, continue to see homes increase here. Right. Key takeaways. The market is slowing. Right? Prices are increasing, just not as fast. We do have better inventory, so it's a better pace for buyers. They don't necessarily have to jump on a home as soon as they see it. They can take their time and look a little bit. And the interest rates seem to be leveling off. Hopefully they level off a little bit. The buyer shouldn't have a fear of missing out because it is a more relaxed atmosphere. But again, in my opinion, I have a lot of clients say, we're going to wait for the market. Everything that I'm reading, both US-wide and knowing what's in the villages, I don't anticipate pricing going down. If there is a crash, it's going to affect your current home up north before it's going to affect the pricing in the villages. So if there is going to be a crash, the delta between selling your home and buying a home down here is going to increase. So when's the best time to buy real estate? 2 years ago. That's just a motto. So which means that the best time to buy real estate is sooner than later. So if you're waiting on the sidelines, hoping pricing will go down, I don't think that's the best strategy at this point. Well, I hope you found the video informative. I was going to say enjoyed it, but these probably are pretty dry and boring a little bit. Sometimes I bore myself as I'm talking, but I hope it was informative, and I hope you got a little bit out of it. If you did like it, please subscribe, hit like. If you like your free 42-page guide, buying and selling a home in the villages, just email me right here at davemontysales@gmail.com, and I'll send you out your copy. Have a great day. Take care, and I'll be seeing you around the villages.